We are going to talk about a strategy of mine that has been discussed a couple of times on streams, but not really in great detail a very, very long time ago. In fact, I came up with this strategy many years ago, and it's something that I use. And not an everyday sort of strategy, but it is a very nice strategy when it does present itself, especially on mid time frames to high time frame structure. Very, very nice model, especially when you have evidence of a previous distribution or an accumulation. It works a lot better, but it's not necessarily required either. And the idea is quite simple, really. What we're looking at is using what we know about ranges. We want to identify a range. So quite clearly, at some point on a lower time frame, this would have been a range high. This would have been a range low, because we know that pulling structure in an uptrending environment, you pull from high to low, price came back to the midpoint, therefore confirming this as a range. Ultimately, you wicked up higher. If we look here, you can tell that if we were to take this range over to the right-hand side, price deviated the range ever so slightly, but it also maintained demand. So this little demand zone held its ground and actually produced a higher high once again. So in this regard, you would have marked out probably a Model 1 YCOP distribution schematic. So you can see evidence of that. You would have taken this guy up. It almost reconfirmed the range, came very close to the midline here. And ultimately, then you would have taken the range high up to here. You would have made two adjustments following the third tap's reclaim of the range and the reconfirmation of that third tap. Then what happened is we had the swing low of the range being engineered for a move up towards the equilibrium once again. Price therefore created a range within a range from this high down to this low. Again, the reason why I'm pulling from high to low is because we went up, down, midpoint, and from there we had a slight deviation of the range high and a deviation of the range low. You deviated from the high, price came to the low. Deviated to low, came back up towards the high, but then ultimately, all of a sudden, volume picks up. Supply comes heavily in control with guns blazing, and you break down from the bigger range model inside of that smaller range model. Here's the bigger one. Here's the tinier one. Ultimately, you broke down from both at the same time, really. That's all fun and games, going through the process of how a range is created. But how do we trade this? Like, what the heck do we do now, right? If we didn't get all those trades, or even if you did get all those trades, maybe you close your short right here. And maybe you lost your last long deviation because you didn't wait for a structure change. You've seen that deviation, price came in, you entered here, and then all of a sudden, crapped out on you. All right, well, let's look at what the heck is going on here. Well, we know that structure must have changed because this was your original range point, and then you broke below that. So the uptrend is no longer intact if you broke down from a range low. If you picked your range high before your low and you break down from that range, then quite clearly you are in an official downtrend as of now. So in saying that, is there a chance that you could mitigate the range, and how do you trade that range in a chance of mitigation? Well, we know that this entire zone is supply, but if you want to cover that whole entire zone, I don't know if that's a great idea. So the way that I like to put emphasis on an order block, it actually involves a lot to do with what Jay likes to use, which is the fixed range tool. And I use it in a range, straight up in a range. So I know you guys are probably familiar with using fixed ranges to find like the point of control, the value area high, the val of a previous range to see what happens when we get back in that range, but it's very similar to that. So my rules for pulling a fixed range within a white phoenix range, we'll call it, or a phoenix range, what we're looking for is we take it from the first point of the range. So if it's in an uptrend, the very first point of our fixed range has to be that high. You take it down to whatever the candle is that closed below the range. So in this case, I'm taking it to the bottom of this black candle. The follow through or the initiation out of the range has been verified by this black candle. I need to include him. So now the question remains, is there supply that matches up with the point of control? Ideally also the equilibrium of this range. And if so, we have ourselves a very, very high confluence supply zone to short. From an order block with imbalance perspective only. I don't really do this with a range-based supply. I only do this if I'm trying to pinpoint within this bigger range-based supply zone. How can I pinpoint this down to identify a tighter supply zone for the best risk to reward? In fact, when I see this model present itself with a distribution, I generally limit order these. Most of the time I limit order them unless it's like a very unusual model that I'm just not sure of, which rarely happens. But one rule of thumb, I like to see price pull away aggressively with increasing volume from the range low, at least a little bit, right? So if I pull my volume in here, we have a few spikes of volume that are higher than recent volume spikes. I like to see that, okay? I want to see some kind of follow through that tells me, hey, we're not coming back in this range just to go higher. Because again, that can happen. All right, well, let's see what happens, right? So now do we have an order block with imbalance that was co-aligning or is co-aligning with the point of control of this range and ideally the equilibrium of the range as well in some way, shape, or form? Yeah, we do. We got this guy right here. And in fact, you could take him up to the top of that candle wick. And in fact, you could take this guy up to the candle wick of the bearish colored candle to the right of it. All right, so this would be a very high confluence supply zone. In fact, you could set a limit on an order like this and then take it down fairly aggressively. So let's see what we have. Looks like we got that tap into the supply, but the follow through is kind of poor so far. Looking a little better. There is a chance that this could be another Wyckoff model and that we may take out this high. And if so, we need to be aware of that. So we don't panic out of the position over a silly purge of the, there you go, yeah. So we didn't panic out of the position because there was a chance it could be a Wyckoff model. But the first take profit for me would always be the larger structure drawing when I'm looking at these models from a mid-time frame perspective. I'm not rushing out of this trade. I'm taking my time. My first profit will be that line. And we are about to hit that. Okay, we just hit that line. All is fine. All is well. Okay, now let's see, just to make sure this is not a one-hit wonder, because I know some people like to question everything. We will find another example. So let's see what we can find here. All right, let's go down to right about, I'm Bybit, I forgot. All right, we can go down to here. All right, so what do we have here? Well, you have a range low that formed, and then you would have had this initial range high in a lower time frame. Now, I don't need to go down because this is not about identification. I'm just showing you guys how we get to that end result. If you want to watch how to draw a range, go back to that video, and you can obviously watch it over and over again while you're practicing. But I'm not going to go down to the 1 minute chart, 2 minute chart from like a year-old price action. That's not going to work. So what we have here is, even though it's not following my guidelines per se, I know that this was a pullback on a lower time frame because this is 1 hour structure. This would have been a range, perhaps on the 5-10 minute. Price then came up to here, sweeping that high, deviating down, but couldn't really close below the equilibrium. And then it came up one more time. Ultimately, you would have ended up with this result here. And I don't know about you guys, but look at that pull away from here. So could this be a Wyckoff model? I would say so. But this is the 1, the 2, and the 3. All right, well, let's try pulling the fixed range to determine where the most volume is within this accumulation model. We'll go from this low. We'll take it up to the candle, including the candle that broke up past that range high. Oh, look at that. We have a demand zone that formed. And how do you know that's a demand zone? Well, if this is your break of structure, that's the last bearish candle. You can also confirm it internally like this if you want to. It doesn't matter to me. As long as you know that that's a demand zone or an order block with imbalance, you're fine. All is well. So in this case here, we have a demand zone that formed on top of the equilibrium, on top of the point of control of that previous range. So guess what? What can we do here? Well, I don't know about you guys, but I think that would be a pretty good long idea. And we'll see what we get. We actually hit that. Of course, I picked the one exchange that may have not hit it, but unfortunately in this example, we didn't hit it. Would that have been a high confluence trade? Absolutely, that would have been a high confluence trade. It appears that we have like almost like equal lows here on Bybit. It makes me wonder if we hit it elsewhere, but anyhow, we'll go ahead and look for another example. Unfortunately, that one missed. Was it a good setup? Oh, absolutely. That was a wonderful setup. So we will check to see, is there anything else we can look at that may resemble a range reversal model? That's what I call it, a range reversal supply or a range reversal demand model. Reversal because by the time it comes back, it then reverses down again. It has to come up to it to reverse back down. Well, we got this range right here. It's near a topping point, so I suspect there may have been a model here. So price came up and formed a swing high. Price therefore came down and formed a swing low, but actually went down to this low first. So we'll actually go with this, right? So we had a swing low. These original swing lows were swept out, reaccumulative on a lower time frame, and then came up and took out that initial swing high with a deviation. You could have shorted that guy down, but we're not here to do that. We're here to find a range reversal model to show how effective they can be. So ultimately, this is looking like a 1, a 2, a 3 tap distribution schematic. So we know there's a potential for a Wyckoff by the rounded figure, knowing that the second tap always has to take out the first tap. Then it's probably a Wyckoff. Even if it's not a tradable Wyckoff, it was probably a Wyckoff. That's all we need to see. So in this case here, we see prices aggressively pulling away from that range low. I don't even have to check volume. I can tell you guys right now that based on the size of these candles and based on the size of recent candles here, here, and here, that's definitely an increase in volume. No question about it. So what do? Well, we do the same thing we did before. We take the fixed range tool between here and here to the candle that broke down with the close, and I accidentally pulled it too far. So right here with the magnet tool, and we make sure that the point of control and the equilibrium line up with a valid supply zone or demand zone. In this case here, it does. Now it's not demand, we have supply. Is it a valid supply? Well, yeah, it's the last up move before this break of structure. The up, the down, the across, and also the last up move between the range low breaking. Really, it's the last one in general. So this is what we call a high confluence short zone. And usually when you get these models, you get one heck of a move. So I would be surprised if we didn't. So price is curling up. I was going to say, I wish we'd left all that liquidity here, but it appears that we swept it all first. So this could have been another range, or it is another range rather. We have a low, we have a high. Price is deviating that low. We could even long it up towards that high. Let's see what we get. Add another one in here. If it breaks that internal structure from left to right, I'm going to add one more. I don't care about ruining my entry if I make money, right? That's the thing people don't seem to understand very well. But okay, I'm going to add one more in here. We broke that left to right structure from a lower time frame perspective. This is definitely a down, up, and across. Actually, it broke it earlier on. I miscalculated that with my eye, which is why you should always check with your trend line tool. But either way, we're still in this trade. Let's see if we get a move up towards that high. Oh, that's nice. So obviously, we're going to partial out or take the whole trade out if we hit that supply. We're going to go short. That's close enough for me. I'm closing that guy out. We're going to look for this short trade from that supply zone. Let's see if we get it. Oh, so close. So, oh, there we go. So this is where we would activate our reversal model. Let's see what we get. Oh, yeah. Now that's what I want to see, right? So from there, we could have taken it down further, obviously. But just to show, for example's sakes, this is not a one-hit wonder, right? We can get very, very effective trades using this model on a regular occurrence. All right. Well, let's see if we can go over to Binance. So that piqued my curiosity before because it's not too often you actually front run those models. So I was like, really? We front ran that model? That's kind of weird. I want to just check it on a different exchange here to see. So I believe what we said was this guy over here. I think it was somewhere in here. Yeah. Okay. There we go. This was the range that we were looking at before. And we ended up with this as the end result of that range. Price ultimately broke up from said range, and we're just going to extend them over a little bit. We know it's an old range. So we have the first swing low would have been here. So we had to pull the fixed range from here up to this candle body close. And there we go. So the POC does match up in Binance. We're going to go with this guy right here, same as before. And we'll see. I don't know if we front run it on this one as well. We might, but we'll see if we get a move off of that. We'll go to the 4 hour, maybe even the 6. And we'll judge this and see what we get. So price ultimately is in that bigger range. This is the bigger range between this swing low and this swing high. You can draw that bigger range out actually. Let's see if we get a mitigation into that. We swept that high. Oh, see? Yeah, that's nice. There we go. Now I don't know if we took it again because I know Bybit wicked down once more. Maybe it wicks down even lower and takes the initial stops out on that. Hopefully not, because I think I would have had my stop to break even on this guy by now, based on that pull away. If it breaks this high, we should, in theory, come up towards this supply zone right here, this little range-based supply or order block with imbalance supply. From there, we're probably coming up towards that high, right? Because there's nothing to stop price in between. Oh yeah, look at that. That right there, you wouldn't even have came back to that. You'd still be in that long today. And for those watching this 5 years in the future, that may still be the case. So from a risk reward standpoint, if that's kind of a trade that you held on to, even towards that range high, how much would you have made off that range-based demand model? Let's see. 17% almost of your account balance. If you took it up all the way up here towards that wick high, this guy over here, then you would have made 41% almost of your account balance. Wow. Now that's a trade. So as you can see, the range reversal demand and range reversal supply model are quite effective again, it's not something you'll see all over the place. I could went into lower time frame examples, but again, I usually keep it above the 15. I don't play with it much on the 1 minute, 3 minute, 5 minute. I know others that I've taught in the past, but I usually tend to trade more actual structure when I'm trading the lower time frames rather than like one side to the other side of a range, like the 3 to 5 minute ranges. But that's ultimately your decision at the end of the day. If you guys want to use this, you absolutely can. You guys know how to use it now. And stay tuned for more.